So about 2 years ago, saw three things happening that did not happen in my lifetime before. I learned that when there is bad finances, and we have bad finances, I mean, if you're spending more than you're earning, and you have a balance sheet that has more liabilities than it has assets, that's bad finances. You can fill that in by printing of money and continue to create debt, but that's not sound finances. Central banks have the ability to do that, and when they do that, that's a problem. So bad finances. When you have bad finances and you have large internal conflicts, that is a risky situation, particularly if you have a downturn, because the rich and the poor and so on, the left and the right, those with different ideologies, have greater internal conflict. And the internal conflict has a risk politically, and it has a risk in terms of the effectiveness. When people are working well together to be productive, that's great. But if you have bad finances and you have large gaps, and you have the rise of a great power challenging an existing great power, and those things happen simultaneously, that's a risky set of circumstances. And then what are the mechanics of that? So for example, so what does it mean to markets? So for example, if you look at every one of those movements, when they immediately print money and do that, you want to buy financial assets. A lesson that I learned. I was clerking on the floor of the New York Stock Exchange in 1971, and President Nixon, on August 15th, 1971, gets on the television and he says, basically, that monetary system that we used to have and what money was, we're not going to have that anymore. It will not be, you can't get the gold. At that time, it used to be that money was like checks in a checkbook. They had no value. They would just get you the gold, and then you'd have the gold, and we're not going to do that anymore. And I figured, okay, now I walk on the floor of the New York Stock Exchange the next morning, got there early, figured we're going to have some sort of pandemonium. And the pandemonium that we had, I thought it was a crisis, and the pandemonium we had was the stock market up the most in decades. And I went back, and I didn't understand that, and I went back and I found out that the exact same thing happened on March 5th, 1933, and Roosevelt did the same thing, and the stock market and gold and all of those assets went up again for the exact same mechanical reason. So I learned two things. I learned, first of all, that I better study things that didn't happen in my lifetime before, because they might happen again. That's what helped us anticipate the 2008 financial crisis. But I also learned that dynamic that when you print money and create that's a hell of a stimulant, but it also means you don't want cash. It means that you want those other assets. So that dynamic is the nature of what we're going through. Cash is a financial asset. You don't want to connect cash. You don't want a bond. It's going to have a negative real return. Like, who wants bonds? You're going to have a negative real return. You want that? Okay. And you're not probably going to get the price appreciation through the bond. There are two ways you can make money. It goes up, or it gives you a good yield. It's not going to give you a good yield, negative real yield, and it's not going to go up much more when you get down to that. So you don't want the bonds. Stocks have an asset. They're a reflation asset throughout history. So there are things that you want. You want stocks. You want gold. You want tangible assets. You want real estate. You want the things that are basically anti-money. And you particularly want those when there's a large portfolio of those. Think about it right now. Through history, what we accumulate are a lot of financial assets. And the only purpose of those financial assets is to take those and convert them into buying things. And when there's a lot of financial assets, and we produce a lot more financial assets, then they're all claims for those other things. And and if you just went through the calculations and you were to say, okay, how much financial assets do you have relative to real assets, or how much are there? there's too many relative to
Right.
real assets. And so you want to get into those things that have more of those intrinsic values. A company is, but there's a cycle, there are three types of monetary policy, and you can almost judge it. There's first monetary policy, one I call it interest rate policy. You move the interest rates up and down. Then when you hit zero interest rate, you don't have that anymore. The next policy that you have is what I call monetary policy 2, which is also called quantitative easing, where a central bank buys bonds from investors, and then it goes in the hands of investors. The money goes to other investments, and investments go up, and those who have investments do well, and so on, but it doesn't trickle down in the same way.
Right.
Monetary policy 3 is when there needs to be a redistribution of wealth. And the way that works is that only the federal government can determine where the money goes. The federal government gets to determine how much I tax and where I distribute it. And the central bank gets to determine how much there is of it, how much money there is of it. And so when the central bank works together with the central government to direct money to give it to others in that way, which increasingly then bypasses investors to some extent and gets money into the checks that we send money around to be able. And so we're in monetary policy 3, where there's a coordination of monetary and fiscal policy to redistribute wealth, to redistribute money in that way. We're in that kind of monetary policy 3. And then you could judge the size of the deficits and how they're being met. And so the debt problem is not a debt problem like we're not going to pay you off those debts, because at the end of the day, they don't choose to pay them. They don't choose to have a debt crisis. At the end of the day, it's just a question of how long it takes them to print more money to monetize those things. So in 1929 to 32 took a long time. 2008 took a lot less time. One took 2.5 years. One took maybe 9 months. This time took like that. And so the next time along those lines, that's what you're going to experience, and then you have that kind of devaluation. So you can see that that's where we are in the cycle. Each of the stimulants has been greater than the one before it. So if you start in, let's say, 1980, and every interest rate increase and every interest rate decrease has brought the interest rates to a lower level. Every peak, every trough in interest rates down till you hit zero. And then when you hit zero, every QE has been larger than the one before.
Is there a way out?
Mechanics of it is have an interest rate that is below the nominal growth rate and below the inflation rate. So you must have an interest rate that way, because think of it this way. If nominal growth in the economy, in other words, inflation plus real growth, let's say it was 3 and 3 or 2 and 2, and that's 4 or 5 or 6, and you kept interest rates at 0, then you are going to reduce your debt to GDP, right? Because you reduce debt service. So if you look at the times that it's been most stretched in history, the world wars would have been the most. If you look at the amount of debt creation and the monetization, you would go back into the 30 to 45 period, and you would see how that operates. So they hold the interest rate down because what you have is the central bank becomes the owner. And the central bank, when they become the buyer, they can tolerate whatever the central bank wants. If the free market goes away and the central bank wants it, that they could hold it. And they hold that interest rate while inflation rate rises. And then what you do is you see your loss of purchasing power, such as we're seeing if you hold it in debt. And that's one of the ways you deal with debt. Well, the issue is really, most importantly, a conflict and a productivity issue. If you have conflict that becomes dysfunctional in operating, historically, sometimes that's the case. We are going there. We're drifting there, okay? That the conflict, so there's a certain amount of, and that has a political implication. But I think that the system is going to change greatly, because there are irreconcilable differences in some way about how do you deal with the money wealth distribution kind of thing. And there's a battle. And right now that battle has been diminished because a lot of people have received checks, and it's not as contentious if all the money goes and we're all now feeling pretty good. It's okay. It's when it happens in 2022 and 2024. If we start to look at 2022, midterm elections are 2024, and that's also the part of the cycle where it's so easy when you give it a good stimulant and everybody's high and it's great. Okay, it's a different thing. When that wears off, and that stimulant will wear off, and it'll produce some other consequences, and you get farther towards 2022 and 2024 and so on, it's going to be a somewhat different picture. And so that clock continues to move. And as we start to imagine it over 2, 3, 4, 5 years, as investors, we should think about beyond the immediate.